Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're going to dive into the fascinating world of initial public offerings, or IPO. An IPO is when a private company decides to become publicly traded by issuing stocks to the general public for the first time. This process allows companies to raise capital from a large number of investors, which can be used to fuel growth, expand operations, and repay debts. But before we dive into the nitty-gritty of IPO, let's take a step back and explore why this concept is so important in the world of business and entrepreneurship. An IPO is often seen as a milestone in a company's journey, marking its transition from a private entity to a publicly traded one. It's a sign that the company has grown to a point where it needs external capital to take its business to the next level. For investors, an IPO provides an opportunity to buy into a company's growth potential and potentially earn significant returns. The process of going public involves several key steps, including filing a registration statement with the Securities and Exchange Commission, conducting roadshows to pitch the company's story to potential investors, and setting an initial offering price for the stocks. Companies typically work with investment banks to navigate this complex process and ensure that they're meeting all the necessary regulatory requirements. One of the key principles behind IPO is the concept of valuation. When a company goes public, it needs to determine its worth in order to set an initial offering price for its stocks. This involves analyzing various factors such as revenue growth, profit margins, industry trends, and competitive landscape. Investors also play a crucial role in the valuation process, as they bid on the company's stocks based on their perceived value. Let's look at some real-world examples of companies that have gone through the IPO process. One notable example is Facebook's IPO in 2012, which was one of the largest tech IPOs in history. The company raised $16 billion in its initial public offering and saw its stock price surge in the following years. Another example is Spotify's direct listing in 2018, which allowed the company to go public without raising new capital or using investment banks as underwriters. However, not all IPOs are successful. Some companies may struggle to meet investor expectations, while others may face challenges in navigating the complexities of being a publicly traded company. For instance, WeWork's IPO attempt in 2019 was met with skepticism from investors who questioned the company's business model and governance structure. The IPO was eventually pulled, and the company had to restructure its operations and leadership team. So, what can we learn from these examples? First, it's essential for companies to have a solid business plan and growth strategy in place before going public. They need to demonstrate a clear path to profitability and be able to articulate their vision to investors. Second, companies must prioritize governance and transparency, ensuring that they have a strong leadership team and adequate controls in place to manage risks. In terms of practical applications, companies can apply the lessons from successful IPO to their own growth strategies. For instance, they can focus on building a strong brand and customer base, investing in research and development, and expanding into new markets. They can also learn from the mistakes of companies that have struggled during their IPO attempts by prioritizing governance, financial discipline, and transparency. Research findings have shown that companies that perform well after an IPO tend to have strong corporate governance, a clear business model, and a talented management team. They also tend to be more transparent and communicative with investors, providing regular updates on their financial performance and growth prospects. On the other hand, companies that struggle after an IPO often lack these characteristics and may face challenges in attracting and retaining top talent, managing growth, and navigating complex regulatory requirements. For example, a study by Ernst & Young found that companies with strong corporate governance tend to outperform their peers in terms of stock price performance and revenue growth. Another study by Harvard Business Review found that companies that prioritize transparency and communication with investors tend to have higher levels of trust and credibility among stakeholders. In conclusion, the IPO process is a complex and fascinating topic that offers insights into the heart of business and finance. By understanding how companies go public, we can appreciate the complexities of market dynamics, financial planning, and entrepreneurial vision. Whether you're looking to launch your own IP someday, or simply want to navigate the world of investments with more confidence, grasping this concept is key. As my friend, a successful entrepreneur, once said, an IPO is not just about raising money, it's about building a legacy. So if you're an aspiring entrepreneur or investor, remember that every great business starts with action. Take the first step today and make your next move count. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.